Welcome to Books in Minutes, where we transform the world's greatest books into powerful lessons you can absorb in one sitting. If you want to grow wiser every day, don't forget to hit the like button and subscribe so you never miss out on timeless knowledge. Today, we're diving into one of the most influential investing books ever written, The Intelligent Investor by Benjamin Graham. Warren Buffett, the most successful investor of our time, once said this is the best book on investing he has ever read. So, if you've ever wanted to master money, avoid costly mistakes, and think like the greatest investors in history, stick around until the end. Benjamin Graham, often called the father of value investing, wrote The Intelligent Investor in 1949. It's not just a book about stocks, it's a guide to thinking wisely about money, risk, and opportunity. This book has changed the way generations of investors approach the market. Unlike books that promise get-rich-quick schemes, Graham's message is the opposite. True investing is about patience, discipline, and protecting yourself from your own emotions. Over the next minutes, we'll walk through the key principles of the book, structured into chapters filled with timeless lessons, real-world stories, and practical wisdom you can apply today. Benjamin Graham begins by drawing a sharp line between investment and speculation. An investment is when you carefully analyze a company, buy it at a reasonable price, and expect steady returns over time. Speculation, on the other hand, is gambling on short-term price movements, like betting that a stock will shoot up tomorrow just because of hype. He warns, most people think they're investing, but in reality, they're speculating. Think about the dot-com bubble of the late 1990s. People were throwing money into any company with .com in its name without even checking if the company had profits. When the bubble burst, trillions of dollars vanished. Graham's first lesson is clear. If you don't know the difference between investing and speculation, the market will teach you the hard way. One of Graham's most famous ideas is the story of Mr. Market. Imagine you own a business, and every day your partner, Mr. Market, comes to you offering to buy your share or sell his share. Sometimes he's optimistic, offering sky-high prices. Other times, he's depressed, offering dirt-cheap prices. The key lesson? You don't have to accept his offer. You can simply ignore him until the price makes sense. This teaches us that the stock market is not your master, it's your servant. Don't follow its mood swings. Instead, take advantage of them. Warren Buffett summed this up best. Be fearful when others are greedy, and greedy when others are fearful. If there's one phrase that defines the intelligent investor, it's this: margin of safety. What does it mean? It's the difference between the real value of an asset and the price you pay for it. Think of it like building a bridge that can hold 10,000 pounds, but only driving trucks of 6,000 pounds across it. That extra capacity is your margin of safety. In investing, it means don't pay $100 for something worth $100. Pay $70, so even if you're wrong, you're still protected. Graham insists that this is the single most important principle of investing. It protects you from bad luck, human error, and even unpredictable events. Graham divides investors into two types: the defensive or passive investor and the enterprising or active investor. The defensive investor is someone who doesn't want to spend too much time analyzing the market. They want safety and steady returns without stress. For them, Graham recommends a simple portfolio strategy: 50% in high-grade bonds, 50% in a diversified group of stocks. This balance protects against both inflation and market crashes. Today, a modern version of this advice might be invest in low-cost index funds. They automatically diversify your money across hundreds of companies, giving you safety, growth, and simplicity. If you're a casual investor, Graham says, don't try to beat the market, just own it. Now, what if you're more active, willing to put in research, time, and effort? That's the enterprising investor. This type of investor looks for undervalued companies, stocks selling for less than their true worth, buying stocks of solid companies when they're temporarily out of favor, looking for low price-to-earnings ratios, studying financial reports carefully. But here's the catch. Being an enterprising investor is hard work. You can't just guess or follow trends. You need patience, discipline, and lots of study. Graham reminds us it's not about being smarter than everyone else. It's about being more disciplined than everyone else. Graham believed the biggest threat to an investor isn't the stock market, it's their own emotions. When stocks rise, greed makes people buy more. When stocks fall, fear makes them sell in panic. This cycle destroys wealth. The intelligent investor must do the opposite. Stay calm when others panic. Be cautious when others are euphoric. Focus on long-term value, not short-term noise. In other words, your success depends more on controlling yourself than controlling the market. Even though Graham wrote this book over 70 years ago, his principles are more relevant today than ever. Think about it. Index funds, one of the most popular investments today, are exactly what Graham recommended for defensive investors. The idea of a margin of safety is used by every great investor, from Warren Buffett to Charlie Munger. The warning against speculation explains why so many people lose money chasing meme stocks and crypto hype. Graham's wisdom is timeless because human psychology doesn't change. Markets evolve, technology changes, but fear and greed remain the same. So what does it mean to be an intelligent investor? It doesn't mean being the smartest person in the room. It means having the discipline to stick to your plan, the patience to think long-term, and the wisdom to protect yourself with a margin of safety. Benjamin Graham wanted us to stop thinking of stocks as lottery tickets and start thinking of them as pieces of real businesses. That shift in perspective is what separates amateurs from true investors. And that's the timeless wisdom of the intelligent investor. If you found these lessons valuable, imagine how powerful your life could be when you start applying them. Remember, investing isn't about quick riches. It's about building wealth safely, slowly, and wisely. Thanks for watching Books in Minutes. If you enjoyed this summary, don't forget to hit the like button, subscribe, and turn on the notification bell so you never miss a book that could change your financial future. Until next time, keep learning, keep growing, and stay intelligent.